morning, everyone. It is Wednesday, February 25th, 2026.
Good morning.
And welcome to your daily briefing. If you're just glancing at the price boards while you pour your coffee this morning, you might actually be tempted to call it a boring day.
Yeah, it really looks that way on the surface.
Right. I mean, we're hovering right around that $65,000 mark. It looks flat. It looks stable. It frankly just looks quiet.
Which is exactly why you shouldn't trust the headline price right now.
Mm-hmm.
Quiet is a very, very dangerous word in this market.
It really is. Because if you actually peel back the layers of the last 24 hours, which is exactly what we're going to do in this deep dive, boring is the absolute last word I'd use. We have a market that feels like it's violently splitting in two.
Yeah, that is absolutely the theme today, the split. On one side, you have this chaotic algorithmic violence, prices getting whipped around by high-frequency trading bots during the State of the Union. And then on the other side, you have this slow, methodical cement being poured by institutions. They're essentially just buying up the plumbing of the network.
And that gap is where the real story is for you watching at home. We need to unpack why the president's speech triggered a massive liquidation event, despite him saying absolutely nothing about crypto.
Nothing at all.
Zero. And we're also going to look at a solo miner who basically beat a 1 in a billion mathematical odd. Honestly, that's my personal favorite story of the morning.
It's the David versus Goliath moment we really needed this week.
Exactly. And we also have to talk about the banks, because they aren't just buying Bitcoin ETFs anymore. They're buying proxy stocks, they're navigating yield curves, and more importantly, they're buying the validator nodes themselves.
Which completely changes the game from investing to controlling.
Yeah.
It's a subtle shift, but a deeply critical one.
So let's just dive right in. Let's start with the immediate context, which was the State of the Union address last night.
Or rather, the market's reaction to what didn't happen at the State of the Union.
Right. So leading up to the speech last night, Bitcoin makes this run. It spikes up to $66,000. I was watching the order books, and it really felt like the market was pricing in something big.
Oh, yeah. The rumor mill was absolutely churning.
People were thinking maybe a policy announcement, maybe a mention of digital innovation, or even that strategic reserve concept that people keep whispering about.
The expectation was definitely there.
Yeah.
But we have to look at who was actually buying, because this wasn't organic long-term accumulation.
Well, the president gets up there. He talks about 53 record highs in equities, 18 trillion in global inflows, and effectively ghosts the crypto industry. Zero mentions. No digital assets, no blockchain, nothing.
Complete silence.
And immediately the price fades back to $65,000. Now, to the average retail trader, that looks like a classic buy the rumor, sell the news disappointment trade. Like, he didn't mention us, so sell the bag.
Yeah, and that is the retail narrative. But if you look at the on-chain data and the exchange flow, that's not exactly what happened. This wasn't just disappointment. It was pure mechanics. We call this algorithmic misdirection.
Okay, let's unpack that. Because misdirection implies a trap.
It was a trap. If you look at the flow data, during that speech window, $52 billion of volume hit the digital asset sector.
Wow.
Yeah, it's a massive injection of liquidity in a very short window. Now, on the surface, a price engaging with $52 billion in volume looks like heavy optimism. But structurally, it was a mechanism designed to trigger a short squeeze.
So the run-up to $66,000 wasn't people getting on the speech at all. It was algorithms pushing the price up specifically to force short sellers to liquidate.
Precisely. And they completely succeeded. We saw over $230 million in short positions liquidated.
Just for the listener who might not trade actively, can we briefly explain what actually happens in that split second when a short is liquidated?
Sure. So if you're shorting Bitcoin, you're betting the price will go down. You're borrowing an asset to sell it, hoping to buy it back cheaper later. If the price goes up instead, your loft increases.
Right.
Eventually, the exchange steps in and says you don't have enough collateral to cover this loss.
Yeah.
And they force close your trade. And how do they do that? They have to buy the asset.
And that forced buying is what drives the price up even further.
Exactly. It triggers the next guy's liquidation and then the next. It's a cascade. So the big players push the price to $66,000 to trigger those automatic buys, flushed out the bears, and once the speech ended with no news, the capital just receded.
So the drop back to $65,000 wasn't a crash. It was just a return to baseline.
Right. The market didn't fail. It just returned to its structural levels. We're seeing very firm support at $64,000 right now. There was a resistance wall at $65,512. Oddly specific, I know.
Yeah.
But that was where a lot of underwater sellers were waiting. We broke it briefly. wipe the shorts, and settle back down.
It's just brutal efficiency. But here is the disconnect that really confuses me. I checked the crypto fear and greed index this morning. It's sitting at an 11. 11? That is extreme fear. If the price is stable at 65,000, why is the sentiment so terrible?
Because retail investors are looking at the macro picture. They see trade wars, they hear about tariffs, they see the silence from the White House, and they just get scared. They think the silence means danger.
Right.
But here is where it gets really interesting. Look at the smart money.
What are they doing right now?
Options traders are buying $58,000 put contracts for March.
But puts are bets that the price will go down. Doesn't that mean the smart money is scared too?
Not necessarily. You have to think of it as insurance. If you own $1 billion of Bitcoin, you don't panic sell because you're worried about a dip. You spend a little bit of money buying puts. If the price crashes, the puts make money and offset your loss. If the price goes up, you just lose the small premium you paid for the insurance.
Yeah.
It tells me the institutions aren't fleeing the asset. They're just buckling your seatbelts.
So retail is panicking and Wall Street is hedging. That's a pretty classic setup.
It is. It's 4D chess versus checkers.
Okay, so that's the high-frequency institutional battlefield. But amidst all that robot trading and hedging, something happened yesterday that feels almost romantic in a mathematical sort of way.
The solo miner. Block 938092.
Yes. This story completely blew my mind. For context for you listening, the Bitcoin mining difficulty is currently at a record high, 144.4 trillion.
Huge.
The network is dominated by massive corporations, the riots, the marathons, with literal warehouses full of ASICs, and yet yesterday, a single person running a tiny rig solved the block.
It is the ultimate David versus Goliath moment. To give you an idea of the odds here, this person rented 1 petahash of power through a service called CK Pool.
Is 1 petahash a lot?
In 2015.
Yes.
In 2026, it's a rounding error. It's a single drop of water in the ocean. It costs them about $75 to rent that power.
$75. And because they found the block, they collected the full reward.
They got the 3.125 Bitcoin block subsidy, plus all the transaction fees. All in, it was about $200,000.
From $75 to $200,000 in 10 minutes, it sounds like they just won the lottery.
Structurally, they did, but it's an incredibly important reminder of how Bitcoin actually works.
Sure.
We talk a lot about centralization, about BlackRock and Fidelity, but at the code level, Bitcoin is still chaotically fair.
Meaning what exactly?
Meaning you cannot buy certainty. You can be a massive mining corporation with $1 billion facility, and you will probably find the next block.
Oh.
But there's always that tiny non-0% chance that a guy in his garage with a $75 rental beats you to it.
So you can buy an advantage, but you can't buy a monopoly.
Correct. The protocol doesn't care who you are. It only cares about the math. And frankly, we really needed that reminder yesterday because the rest of the news cycle is heavily tilted toward the corporate takeover.
It definitely is. Let's pivot to those institutional flows then, because while the solo miner was getting lucky, the big funds were making huge moves. We saw a shift in ETF flows yesterday, didn't we?
We did. For the first time in 5 weeks, the spot Bitcoin ETFs saw net inflows. $257.7 million came in on February 24th. Fidelity led the pack with $83 million, and BlackRock was close behind with $79.
That breaks a pretty nasty streak of outflows. Does this mean the correction is over? Are we back in up-only mode?
I would urge a lot of caution there. One day does not make a trend. This looks a lot more like a tactical rebalance. Asset managers often move capital around to capture liquidity or adjust weightings right at the end of the month.
Okay, so don't pop the champagne just yet.
Not yet. But there's a much more significant institutional story developing with Anchorage Digital.
Right, the crypto bank. They announced they're purchasing STRC. Now, I had to look this up. STRC is a perpetual preferred security issued by MicroStrategy.
Yes, and it pays an 11.25% cash dividend.
My question is, Anchorage is a federally chartered crypto bank. Why are they buying a MicroStrategy derivative instead of just buying actual Bitcoin?
This is where we get into synthetic yield engineering. Because holding physical Bitcoin is actually very expensive for a bank.
Expensive how? It's digital. It doesn't take up warehouse space.
It takes up regulatory space. Under the current capital requirement rules, if a bank holds $100 of Bitcoin on its balance sheet, it often has to hold a massive amount of cash in reserve against it, sometimes dollar for dollar. It just kills their capital efficiency.
Ah, so STRC is a workaround.
It's a wrapper. By buying STRC, Anchorage technically owns a security, not a commodity. It's easier to regulate, it's easier to clear, and here is the real kicker. It pays them an 11% cash yield. Bitcoin by itself pays zero yield.
So they get exposure to Bitcoin's price action since MicroStrategy is basically a Bitcoin proxy at this point, plus a fat dividend minus the regulatory headache.
Exactly. It solves the compliance problem and the revenue problem simultaneously. But this brings us to the giant elephant in the room, which is MicroStrategy itself.
Right. I keep seeing these doom loop threads on social media. People are pointing out that MicroStrategy holds nearly 718,000 Bitcoin, but their average cost basis is $76,000.
Which means at today's price of $65,000, they're sitting on a roughly $7 billion paper loss.
That sounds absolutely terrifying. The bear case is that if Bitcoin drops further, MicroStrategy gets a margin call, they're forced to liquidate 700,000 Bitcoin, and the whole market just goes to zero. Is that a real risk?
It's a very scary narrative, but it largely ignores the actual legal structure of their debt.
Yeah.
Michael Saylor didn't take out a margin loan like a degenerate gambler on an exchange. He used unsecured convertible senior notes.
Okay, unpack that jargon for us. What does unsecured mean in this context?
It means the loan is not backed by the Bitcoin itself in a way that allows the lender to just seize it if the price drops. There are no price-based margin calls.
Wait, so if Bitcoin goes to $20,000 tomorrow, nobody can call Saylor and say, pay me or we sell your coins?
No, they can't. The lenders have to wait until the notes actually mature, which happens between 2027 and 2029, depending on the specific note. As long as MicroStrategy can pay the interest payments, which Saylor has confirmed they have distinct cash reserves set aside for, they're not forced to sell a single Satoshi.
So the forced liquidation theory is...
It's mostly a ghost story. It is technically possible in a total bankruptcy scenario, but we are very, very far from that. The market is pricing in a risk that simply doesn't exist in the contract terms.
That is a crucial distinction for people to understand. The market thinks they're cornered, but they actually have a multi-year runway.
Which is exactly why the smart money plays the yield via STRC, while the retail traders panic about the paper loss.
All right, let's move to the regulatory side of things, because the net is definitely tightening. We've got news involving Binance and a U.S. senator.
Senator Richard Blumenthal. He has officially opened a formal inquiry into Binance.
This sounds serious. What are the actual allegations?
It's heavy. The inquiry cites internal compliance reports, documents that came from inside the company, that flagged $1.7 billion in transfers linked to Iranian proxies, Russian shadow fleets, and militant groups.
1.7 billion, that's massive.
Yes. And the allegation is that when internal staff flagged these transactions, Binance fired them. The inquiry is also drawing links between Binance and World Liberty Financial, which is really raising eyebrows given the political connections there.
So what does this actually mean for the average user or the broader market? We know regulators have always hated offshore exchanges. What's new here?
It means the era of offshore liquidity is fracturing. Traditional finance institutions, the BlackRocks, the Fidelities, they cannot touch sanctioned entities or exchanges that facilitate them. They have to withdraw capital from offshore platforms just to protect their domestic banking charters.
So the liquidity splits. You have the clean U.S. market and the dirty offshore market.
And the gap between them becomes much harder to cross. But it's not just investigations right now, it's actual seizures. Look at what happened in North Carolina yesterday.
Okay, the Tether story. Prosecutors seize $61 million in USDT linked to a pig butchering scam.
This was a massive wake-up call for anyone who thinks stablecoins are crypto in the sovereign sense. The feds didn't just ask nicely for the money. They mapped the blockchain, they identified the wallets, and they commanded the Tether smart contract to freeze the funds.
They can just do that.
The code completely allows it. The smart contract simply rejected all transfer attempts. The money didn't move, it just stopped existing as a transferable asset.
Wow. That completely destroys the idea of censorship resistance for stablecoins.
It really does. And this is the aha moment for fiduciaries. If you're holding $60 million in Tether, you are holding a digital IOU that can be canceled by a database administrator or a court order. If you want absolute sovereignty, an asset that truly cannot be frozen, you are being pushed right back to base layer Bitcoin.
Because nobody can call the CEO of Bitcoin and ask them to freeze a wallet.
Exactly. And that utility is becoming so much more valuable as surveillance increases. Speaking of surveillance, did you see the launch from TRM Labs and Finray?
Yeah, this sounded like something out of a sci-fi movie. They're using AI to connect fiat bank wires directly to crypto wallet addresses.
Correct. It automates compliance for things like MiCA in Europe and US AML laws. The software scans sanctions lists and risk profiles in real time.
So if I wire money from my bank to an exchange and then move it to a private wallet, this AI is tracking the whole chain.
Yes. It effectively ends the era of anonymous transfers for anyone touching the traditional banking system. If you want to off-ramp to a bank, you must be tracked. We're moving toward a world where privacy is treated as suspicious by default.
That is a sobering thought. It really reinforces that split market theme we talked about. You're either in the system, fully surveilled, or you're out of it, and it's getting significantly harder to get back in.
Precisely. And the system itself is consolidating right in front of us. We saw another acquisition today that flew under the radar for most people, but it's actually huge for infrastructure.
You mean Bitwise acquiring Chorus One?
Yes, Chorus One isn't just a wallet provider. They manage $2.2 billion in stake assets across 30 different protocols.
And Bitwise is a massive traditional asset manager, so they aren't just selling ETFs anymore.
No, and this is the major shift. By acquiring Chorus One, Bitwise just absorbed 50 specialized engineers. They are now running the validator nodes themselves.
So explain the so what here for the listener. Why does it matter if Bitwise runs a node?
It matters because it means traditional finance firms are moving from passive investment, which is just holding the coin, to active network control. Validator nodes vote on protocol upgrades. They decide on governance. When Wall Street firms own the validators, they effectively dictate the future of these networks from their corporate boardrooms.
That is a very significant departure from the decentralized dream.
It's the industrialization of proof of stake. It's cleaner, it's safer for retail investors, but it centralizes control in a way that we really need to keep a close eye on.
So let's recap what we've learned today. We have a price that looks boring, but is actually being manipulated by $50 billion algorithmic flows. We have a solo miner proving that the little guy still has a mathematical chance.
Right.
We have banks buying proxy stocks like STRC to avoid holding actual Bitcoin, while regulators and AI are closing the net on privacy and offshore exchanges. And finally, Wall Street is literally buying the infrastructure of the network itself.
That sums it up perfectly. It is a market defined by a widening chasm between the clean, corporate, surveilled assets and the raw sovereign base layer.
It's a lot to process. As we wrap up this briefing, what is the one thing you want our listener to walk away thinking about today?
I really want you to think about that tether seizure. If a smart contract can freeze $60 million in an instant, and if AI can track every compliant penny you move, is the premium on base layer sovereignty, meaning actual Bitcoin held in cold storage, about to skyrocket. Not because of speculation and not because of an ETF, but simply because it might be the only asset left in the world that cannot be frozen.
That is a very powerful thought to leave us on, the true utility of being unfreezable. Thank you for tuning in to today's deep dive. We'll be back tomorrow to see if that $64,000 support holds.
See you then.